My name is Dana Frisbee, and I'm a HUD certified housing counselor. I've worked with first-time home buyers, and basically I'm an advocate for the consumer to assist them with being successful at purchasing their first home. I'd like to first thank Senator Art Haywood for providing this platform to share the information and the resources for the consumer so to go towards their success. Thank you very much. Qualifying for a mortgage can be intimidating, to say the least. By learning the expectations of the lender to qualify for a mortgage is guaranteed success. So I'm gonna say that again. You learn what's expected of you by the person that's lending you the money. And once you've done that, then you can move forward in becoming a successful home buyer. Standards may vary from lender to lender, but there are 4 core components that the lender evaluates from the consumer. And they are, I'm sorry, I can't see the thing, so I'm just going to keep going and we'll stay together. What I also wanted to say is that housing counseling agencies are throughout the city of Philadelphia. Mount Airy CDC happens to be one of them. So you're welcomed to get counseling by any one of those agencies. And please, again, you're welcomed and do so. So the 4 core components that the lender evaluates is what they call the 4 C's of credit. And the lender, what they look at is your character, your capacity, your capital, and your your collateral. So what they do is the lender looks at your credit score and the history of your payments to your creditors, or whether you're on time, how many creditors you have, to assess how you pay back those folks. Because they want to know what? If they're going to get their money back. That's what they want to know. And what they also want to know is how much debt you have. Because if your cup runneth over with debt, then there's no room for anything else to happen. The minimum credit score for most lenders, because like I said, it varies from lender to lender how they qualify you. But as a rule of thumb, we like to say 640 is the credit score that qualifies you for a mortgage. Some lenders say 620, okay, fine. But a 640 credit score, or your credit score period, dictates your level of risk to the lender. A 640 credit score will qualify you for that mortgage. But what the lender does is he looks at, and he knows statistically that out of every 5 people with a 640, 1 person may default on the loan. Okay, so those ratios aren't that good. Because they know out of every 5 people, only one's going to not pay them back. Is it you? Right? But a 660 or above get you a better lender's product and better features to their product. So you're not going with begging. You're saying, no, I'm stable. I pay my bills on time. I have enough credit that I can manage. So when he looks at that 660, he knows out of every 10 people, only one of you are not going to pay him back. So those odds are much better, much favorable. So what that dictates is your interest rate that he gives you. So the features to his product, the opportunity that he's going to give you to lend you his money. The interest rate is what you owe them. You pay them back that, you owe them that for borrowing their money. So if your credit score dictates that, you want a what? A better credit score, okay? Let me get some water, you guys. It also dictates not just the interest rate, but your down payment requirements. How much money are you going to need to put up? Do you qualify for down payment and closing cost opportunities with that credit score? So that's your character. Thank you. The capacity is your ability to pay back the loan. So you have to provide the lender with proof of your monthly income, regardless of what it is. It needs to be consistent. They assess your income, and again, your debt, to yield how much house you can afford. Because nobody wants to be house poor, right? So the next is your capital. How much savings have you put aside for this this major purchase? You just can't go out and say, I want a house, let me get some grants, and let me move on. You have to have some stake in the game. And you have to have it because you need earnest money to take that house off the market. You have to have a down payment. You have to have some type of closing cost funds and the lender's upfront fees. Now, some lenders charge you to do an appraisal on their property. Some don't. And you need home inspection. You got to find out whether this house is the construction, the structure, and the systems in the house are operable. And if they are, what is the projected, do they need to be repaired or replaced? And if so, then you negotiate those with the seller. So that is why the capital is so important, your savings. The collateral, the lender looks at the house that they're loaning you the money for the house, that's the collateral. Because if you don't pay that, they're going to come back and they're going to take that house back. Now, we are a judicial county and state, and when those things happen, you have to go to court. It does prolong the life of the consumer to be in the house, but no, we don't want you to start out on that foot. We don't want you to do that. The key factors here are basically know what's on your credit report. Annualcreditreport.com will tell you what's on that report. I know some of your banking people, or you guys have different apps, they tell you what your credit score is and what's on your credit report. Know what's on there. And when you find discrepancies, what should you do? You dispute it and get that stuff cleared up. We're advocates for you, and we want to see you succeed. And again, thanks to Art Haywood to bring this together so that we can come together as one and communicate what is needed and what is wanted and connect us with all of the fine folks that are here today. All right, I don't want to go on a tangent, so let me stay focused. Budgeting for your mortgage payment. So, your principal is the amount of money you borrow. Your interest is the cost of borrowing that money. Taxes got to be paid to the city of Philadelphia or the county for you having that property. That's just a no-brainer. You got to do it. And homeowners insurance to insure that property, because the lender's not going to lend you the money if that property is not insured. So how do you budget for that? You have to know, again, what that looks like for you. So the lender will let you know how much house you can afford and what it looks like for you with your principal, interest, taxes, and insurance. And they call it PITI. Along with budgeting for that, once you find out what that is, you still have your food, you still have your electricity, you still have your water, you still have your heat that you have to pay. You still have those creditors that you have. You have clothing, you have life insurance, you have your car. So these things have to be a part of that scenario for PITI. And the lender, again, is going to make sure that there's enough money to go around for that. And student loan is a whole nother issue. But after all your bills are paid, it's difficult to set aside money for emergency funds because that's critical. When you own your home, there's no longer anyone that's going to come and you call the landlord and say, look, the roof is leaking, I need it fixed. Or even if you know, again, from your home inspector, that there are some repairs that may need to be done, but not right now, but in the future, and you're going to keep that on your radar for your maintenance of the property. So you need emergency money. The rule of thumb is 3 to 6 months of your monthly expenses in an account for, here we go again, with savings. The key factors here is to build a budget on your bring home pay. That's what you're working with, what you bring home. Track your spending. It's okay to sit down and say, you know, oh, this is where I went to maybe somewhere too many times. So I got to cut that down a little bit. It's okay to take a look at what you're spending, what's coming in. You have to do it. Get yourself in a comfortable place and sit down and relax and invite your children in it, invite your family in it, because this is financial literacy. And this is what upholds us in the community by way of generational wealth. Tweak your budget when needed. It's not one and done. When this thing gets out of control, or when you look at things and say, oh, well, I'm not getting my Wawa coffee the way I want to, then you budget so that you can still have your quality of life. You still want your Wawa coffee. You still should have it. And next on the agenda, and I hope I'm still doing good with time, thank you, is the grants that are available for down payment and closing costs. There are a multitude of grants that are available. And as I know, as you've been walking around talking with the different lenders, they have been telling you about some of the grants that they have in-house, which is significant. But what I didn't put on here was Mount Airy CDC's grant, and I apologize. There is a $2,000 grant that we have by way of a donor. This woman donated money. She was very adamant about people of color, low to moderate income folk being able to purchase a home, being able to have generational wealth in the community. And so she donated money, and our agency had other people match that money, and so we do have a $2,000 grant available for those folks who come in and complete counseling and move on and get their homes and those kinds of things. There are other community development corporations that have their own in-house grant for completing housing counseling too. Now, Philly First, Down Payment and Closing Costs Assistance Program. This program is generated from the city of Philadelphia. Excellent opportunity. It's 6% of the sales price of the house, or $10,000, whichever is less. But with all of these grants, and with this grant too, you need to know the terms of the grant. What does it mean when I accept, or if I qualify for this grant? What does it mean for me? What do I have to do? So with Philly First, it's a 15-year term. So meaning you have to stay in that house for 15 years. Or you have, if you decide that you want to sell that home, or if you decide that you want to move, you have to do what? Pay the city of Philadelphia their money back. Now, with that grant also, they want you to be within a certain debt-to-income ratio to keep you balanced so that you're not living house poor, so that you can still have those opportunities for your quality of life, your vacations, your different things that you like. So what you want to know is, will the lender be able to pair that grant with their product? Because not all lenders will accept certain grants. And I'll tell you why. The lender has the first lien on the property. The money he lent you, he has a lien on that property for that money until you pay it. And they're called like the first lien holder on the property. Philly First and K-Fit, I didn't talk about K-Fit yet, but K-Fit is a 10-year term grant. And they will go second position. They will only be the second lien holder. So you can't get both of those. You can only get one, but they're the second lien holder on the property. But the lender has to say, I will allow this second lien holder to be a part of my product and my features to my product. So again, it's paramount that you know your lender's product. You know the features to his product, what he will and will not do for you. That said, and I'll keep talking about the grants, but there's so much information, there's so many variables, okay? You're just not one and done. And, but anyway, okay. You have a 30-day window to shop for multiple lenders. It's a hard pull on you, but in the industry, if you shop, it's only going to be that one pool. But then you can compare and contrast where you get in, where you fit in, what's best for you. And so that said, the lenders also have their own in-house grants. And you want to know that too. You want to know what they have to offer. And First Front Door, that's another grant. That grant, the beauty in that grant is that when you're approved, you have 6 months, right, Irv? Irv, you have 6 months. Irv is our to-go-to person at Mount Airy. Shantae is here. I think, I didn't see everybody else, but these are lenders, our to-go-to lenders. These are folks that we refer people to because we know that they're going to take care of them. And suspect of predatory lending is not on the radar. So, I'm going off on a tangent again. But anyway, First Front Door, once you're approved, you have 6 months to find a house. And so that grant is held for you. The other grants aren't that way. But more importantly, what I want you to do is I want you to investigate, Google these opportunities, these grant opportunities, to see where you get in and where you may fit in. But more importantly, you have to understand the policies, the procedures, and the guidelines of these forgivable grants, forgivable loans, or if there is something else attached to you receiving these down payment and or closing cost assistance opportunities. I put some resources on the last page. Google it. They'll tell you, these agencies who fund us will have all of that information there for you. But more importantly, see a housing counselor. And for some of those grants, you have to see one to get a certificate of completion in order to qualify for those grants.